What's up, traders? Welcome to today's Equity Empire Chart Analysis session. My name is John McHugh. I'm a former Wall Street analyst, hedge fund manager, and independent trader for the better part of 20 years. Today, we're going to be taking a look at the chart of a household name that looks like there could be a good trading opportunity in the chart. But before we do that, we're going to take a look from a trade setup that I posted on YouTube about 5 weeks ago. And that trade setup was this. The trade setup was Zscaler, cybersecurity company, symbol ZS. And the game plan was to wait for a pullback into the 218 price range to bounce off that level before heading considerably higher. And that's exactly what Zscaler did. So almost immediately, Zscaler pulled back into the 218 price range. Take a look at that a little more closely. So almost immediately, gapped down to the 218 price range and bounced immediately off that level. So you would have been filled if you had a buy limit order at the 218 price range. You would have been filled right at 218, and it almost immediately bounced right off that level. A good trader friend of mine calls that the NDM trade, never down money. You're all in profits almost immediately from your entry. Okay. Now, over the course of the next 5 weeks until today, this is what Zscaler has done. So Zscaler over the last 5 weeks has bounced 75 points off of that level, and we were only going to take $2.50 worth of risk. So that if you entered at 218, you'd be sitting on a 30-to-1 reward to risk setup right now. You'd be up 75 points, and that would be 30 times the amount of risk you're willing to take for that particular trade. Now, why is a reward to risk ratio so important? It's so important because let's say you're just taking $100 worth of risk. So if you took $100 worth of risk in that trade and you held on to it to today, you'd be sitting on about a $3,000 profit. So when you're sitting on a $3,000 profit and you're risking $100 worth of per trade, you could literally screw up the next 29 trades you do and still break even. So reward to risk ratio is the most important consideration of every trade setup that I post here on YouTube. It's the most important consideration of every trade that most of the professionals that I know employ. Okay, so this is not just cherry picking. If we go back to the YouTube page, there's been several trade setups that have worked out to very high reward to risk ratios. CyberArk most recently is sitting about 5-to-1 right now. Micron was a big reward to risk trade. AST Space Mobile, Palantir, CrowdStrike. I could go on and on and on about trades that have played out with very high reward to risk ratios since I started posting a little over a month ago. But we're not here just to review. We're here to learn and look at another potential trade setup. And the trade setup we're going to look at today is the stock of Sprouts Farmers Market, the organic produce grocer. Okay, so we're going to pull up Sprouts Farmers Market, symbol SFM, and we're going to take a quick look at the chart on a daily time frame. And the first thing I'm going to do here, which I haven't done yet on YouTube, is going to go old school. So I learned technical analysis. My original mentor for chart reading was the late, great William O'Neill, the founder of Investors Business Daily. And we learned back in the, dating myself a bit here, but back in the 1990s, a formation called the cup and handle formation. And so let me describe what that looks like. So from this peak here, think of this as a big giant cup, and then this as a cup handle. So there's your cup and handle formation. So cup, handle, breakout. So that's called the cup and handle breakout. So what we could be looking for if we were back in the 90s is we could look at for a breakout above the dashed red line here, to break out above there and just head off into all-time highs. Okay, so that would be an old school way to trade this particular setup. But William O'Neill admits that about well, I don't know what the stat is today, but at one point in the past, he pointed out that about half of these cup and handle breakouts would pull back at some point. So before heading higher, or sometimes just fail completely. So what we're going to do, instead of buying at the breakout point here, maybe Sprouts SFM just heads off out to the skies, heads into the clouds. Well, if that's the case, we simply will let it'll just have to go without us. Because you'll notice in all the trade setups that I've done so far, they've been largely pullback setups. Now, at some point, I will be doing breakout trades. So that's not something I just never do anymore. But in this particular case, we're going to exercise a little more discipline. I am going to point out another technical formation, another technical clue, and that is this. This is called the ascending triangle. So the lows keep heading higher and higher and higher, and the high just touched the last two previous highs. So we have an ascending triangle, and ascending triangles have a tendency to resolve themselves with a breakout to the upside. Now, we could just break out right above here and take off. If that's the case, once again, it's just going to have to go without us. So the way we're going to construct this trade is to wait for a pullback into a support level before entering the trade. And we could, if we stayed on hourly daily candles, we could be looking for an entry somewhere here in the 169 price range. But I'm going to change time frame to go see if there's a higher support level to potentially enter in. And if we go down to 15-minute candles, we can see that there is a support level right here in the, call it the 176.5 to 174.74 price range. There is another support level. We can call that right at the breakout point. There's several different support levels here. You could actually use this as a support level right there if you wanted to trade that one instead. There's a support level. These aren't great support levels. There's actually one just below there. I'm working on a few different levels here. I'll give you options to consider which level you want to if you so desire, which level you might consider as a pullback into a level to trade. And then there's, if you want to be even more patient, this was the high time frame daily support level that we saw in the chart. Okay, so we've got 4 potential support levels to trade, and if we go back, we can see that we don't have any technical resistance to be worried about. So a pullback into any one of these levels could be tradable. So the way you could construct a trade, if you want to get aggressive, you could go for the top level. If you want to be kind of like not too hot, not too cold, the Goldilocks zones right here in the middle, price might not pull back all the way down there, but you'll have more reward to relative to the risk. And if you want to be a really patient investor, or patiently wait for a potential pullback into 168, there's another option. But the most aggressive trade here would be pretty close to the breakout trade, which would be you wait for a pullback into this 176 type price range before heading higher. So we're going to construct our trade like this. Put a buy limit order at 176.56, protective stop just below the 174.74 level. And since there is no technical resistance, we can set our target. I tell you what, folks, I haven't done this yet. I'm just going to place a target way up here. I'll just call it like 5-to-1 reward to risk. And if it gets close to that, won't have a target. So if this does bounce off this level and start heading higher, we'll just trail the stop and just not have a target. But I want to just, for the sake of this exercise, use that tool to show at least a 5-to-1 where a 5-to-1 reward to risk might be. So ideally, the game plan, ideally the trade would do something like this. Ideally, Sprouts would pull back to the 176.56 price range, bounce off it like it did on Zscaler, and then head off to all-time highs. Okay, that would be the ideal setup. In this case, we could have a protective stop. Let me take this line off here. That was the breakout point. You could place a protective stop once again in the just below the 174.74 price range. So your protective stop would be right below there. So if we pull back and continue pulling back, you only take less than a couple of dollars worth of risk per share for that particular trade for much greater reward potential. Once again, if you wanted to take one of these other levels, you could take one of these other levels. And if you wanted for a much greater price discount for your entry, you could consider this good looking support level down here in the 168 price range. So let's wrap up today's session, folks. Hope you enjoyed the session. We covered a lot of ground today. There were a few lessons. There's a little bit of recap of a really exciting trade that played out with a 30-to-1 reward to risk ratio. Obviously, not all trades are going to be 30-to-1, but that is kind of the ideal kind of trade play out. So let's wrap it up, folks. So once again, I hope you enjoyed the session. I'll be back each and every day this week for more chart analysis. In the meantime, wishing you the best of luck in your trading and investing, and we'll